In January of this year, a 74-year-old man in Ohio deposited an $85,000 life insurance check after his wife of 52 years died. His bank froze his account, not for 72 hours, not for a week, for 93 days. 2 automatic bill payments bounced. His Medicare supplement coverage lapsed. No one told him why. No one apologized when it ended. The bank simply told him his account was reactivated. That freeze was legal. The bank was protected from any liability for it. And what I'm about to show you is that in January 2026, the rules governing that freeze got significantly worse. And the proposal sitting in front of regulators right now would allow a bank to freeze your account for up to 145 business days. That is 7 months. By the end of this video, you'll know exactly which transactions are triggering these freezes and the 5 moves that protect you before it happens to yours. But stay with me, because what banks can now do that didn't exist 5 years ago is the part almost nobody is covering. To understand what's new, you need to understand the foundation. The Bank Secrecy Act was signed into law in 1970. It requires every bank in the United States to file a currency transaction report with the Financial Crimes Enforcement Network anytime a customer deposits, withdraws, or transfers more than $10,000 in cash in a single day. The report includes your full legal name, your social security number, your date of birth, your account number, and the exact amount moved. You are not notified. You do not receive a copy. That threshold, $10,000, has never been adjusted for inflation. Not once in 56 years, adjusted for inflation. That threshold today would be $81,000. Congress never moved it, which means a single car sale crosses it, an insurance payout crosses it, moving retirement savings after a spouse dies crosses it. The ordinary transactions of an ordinary retiree now trigger a federal report multiple times a year. The moment most people learn about the $10,000 threshold, the instinct is immediate. Stay under it. That instinct is a federal crime. Under 31 U.S.C. Section 5324, deliberately breaking up transactions to avoid triggering the reporting threshold is called structuring. Up to 5 years in federal prison, fines up to $250,000. Civil forfeiture of the funds, even if every dollar is legally yours. Now, the law does not require criminal money. It requires only the intent to avoid the report. Carol Hinders ran a Mexican restaurant in Iowa for nearly 40 years. She deposited her daily cash receipts always under $10,000 because that was what her daily receipts were. The IRS seized her entire bank account, $33,000, no criminal charges, ever. She spent 18 months fighting to get her own money back. Randy Sowers ran South Mountain Creamery in Maryland. He deposited his farm stand cash receipts in amounts typically under $10,000. The IRS seized $63,000 from his operating account, not charged with a crime. The IRS conducted an internal study of civil forfeiture cases pursued under structuring law. 91% of the people whose money was seized had funds from completely legal sources, 9 out of 10. Congress designed this law to catch drug money. 9 out of 10 people who lost their savings were not moving drug money. They were moving their own. There is a second kind of federal report that most people have never heard of. And unlike the CTR, it has no minimum dollar amount. It is called a Suspicious Activity Report, ASAR. Your bank can file one on a $50 transaction. A pattern of payments a compliance officer decides looks unusual, even if every dollar is clean. Banks filed over 4 million suspicious activity reports in 2024. Under federal law, your bank is legally prohibited from telling you a SAR was filed on your account. If you ask directly, they are required to neither confirm nor deny it. The SAR sits in FinCEN's database for 5 years. For widows and widowers, the exposure is greatest. Life insurance proceeds, inherited retirement distributions, home sale proceeds, all arriving in the same grief window. Banks tune their compliance software specifically for this pattern. They call it the fraud triangle. More senior accounts are frozen in the 3 months following a spouse's death than at any other point in a retiree's financial life. We are still not at the worst part. Here is what changed in 2026. FINRA Rule 2165 already gave broker-dealers a legally protected safe harbor to freeze a senior account if they believe financial exploitation may be occurring, not is occurring. Maybe. No court order required, no criminal charge required. On January 8th, 2026, FINRA issued Regulatory Notice 2602. The proposal: extend the maximum hold period from 55 business days to 145 business days. 7 months. Your account, your money, frozen. No court order required, no criminal charge required, no explanation required. But that is not the most significant part of Notice 2602. The same notice proposes a new rule, Rule 2166, that would extend temporary hold authority to accounts belonging to any investor, not just seniors, not just people over 65, any account, any age. The Senior Protection Framework was the test case. The mechanism is now being proposed for everyone. At the same time, banks are running behavioral surveillance on every transaction in your account. AI systems build a baseline from your transaction history, your typical amounts, your usual recipients, your login device, your location. Any deviation triggers an automated review, a new device, a different location, a transfer amount outside your historical range, a recipient you've never sent to before. This is why the man in Ohio had his account frozen on an $85,000 insurance deposit. His compliance software had indexed 31 years of $2,000 monthly deposits. It had never seen $85,000 before. The flag was automatic. A human never reviewed it before the freeze was already in place. The threshold the software uses is not the legal $10,000. It is anything that looks different from what you normally do. Most people assume that in the United States, the government must charge you with a crime before it can take your money. That assumption is wrong. Under federal civil asset forfeiture law, the government can seize your funds without filing a criminal charge, without an arrest, without a conviction. Once the money is gone, the burden reverses. You must prove to a federal court that your funds were not connected to a crime. Legal fees to contest a federal forfeiture typically run between $3,000 and $10,000, which means for smaller seizures, it is often cheaper to abandon your own money than to fight for it. Carol Hinders, Randy Sowers, none charged, all had to fight to recover funds the government took first and justified later. Here is the good news. Every risk I just described is navigable. There are 5 specific moves you can make this week. Move 1. Make large transactions as a single deposit or withdrawal, not several smaller ones. One transaction above $10,000 triggers a CTR, a routine filing that costs you nothing and creates a paper trail that protects you. Multiple transactions below $10,000 trigger a structuring investigation. Move it all at once. Move 2. Pre-notify your bank in writing before any large transaction. Call your branch before any deposit or transfer of $8,000 or more. Ask to speak with a compliance officer. Tell them the amount, the date, and the source. Ask them to note it in your file. What takes 90 days without that conversation can take 3 days with it. Move 3. Build a paper source file. For every transaction over $5,000, date, amount, source, recipient, purpose. Keep the car sale receipt. Keep the insurance payout document. Almost every forfeiture case that caught an innocent retiree turned on whether they could produce documentation of why their deposit pattern looked the way it did. Move 4. If your account is ever frozen without explanation, file a CFPB complaint the same day. Go to consumerfinance.gov and file it that day. A CFPB complaint forces the bank to respond on a federal regulatory timeline. In most documented cases, the hold lifts within 10 business days, even while the underlying SAR review is still open. This costs nothing. It takes 15 minutes. Your bank will never tell you about it. Move 5. Request the trusted contact designation from every bank where you hold an account. This designates a family member, attorney, or financial advisor the bank is authorized to contact before placing a hold. Under FINRA Rule 2165, if a freeze is placed and you have a trusted contact on file, the bank must notify that person. Someone who knows your finances will know within hours, not 7 months. The man in Ohio did not have one on file. File this form. Every account. 15 minutes. This video is for informational purposes only and is not legal or financial advice. If your account has been frozen or your funds have been seized, consult a licensed attorney with experience in federal financial law or civil asset forfeiture. If this video showed you something about your own money that you didn't know before you clicked play, that is exactly why this channel exists. Subscribe if you haven't already, and share this with someone over 60 who has real savings in a bank account. The rules have changed. Almost nobody is telling them. You can be the person who does. Drop a comment. Have you or someone you know ever had a bank account frozen, a withdrawal delayed, or a large deposit questioned with no explanation? Tell me what happened. I read every one.